Hi everyone, good morning. Today we are going to start one of the most important concept in finance, which is the cash flows. So many businesses actually fail not because they are unprofitable, but they run out of cash. And therefore, understanding cash flow is very critical for students, managers, entrepreneurs, or investors. So let's understand what does the cash flow means. When we talk about cash flow actually refers to the net amount of actual cash and cash equivalents. Uh, and it represents moving in or moving out of cash from an entity during a specific period. And the specific periods could be day, months, quarter, or year. Depends on the frequency of your recording. So it also answers one core question actually. So how much real money is available and where it is coming from or it's going to. Unlike accounting profit, cash flow actually ignores when revenue is recognized, but only focuses on when cash actually changes hand. And this is the definition, the basic uh, core principle of when we talk about cash flows. We are only going to record the cash in the cash flow statement when it changes hand. This means either we are receiving money, it's an inflow, or an outflow of cash. Cash flow, when we compare the cash inflows and outflows, so there are two sides. Now, cash inflow, which is the source of cash, and cash outflow is the uses of cash. The cash inflows, the basic examples, I have listed some of the examples here. So cash inflows are represented by cash received from customers, interest or dividend income. This is an inflow. Uh, Proceeds from selling assets. This is going to be an outflow. And loans taken or capital raised from investors. Okay, proceeds from selling assets is also an inflow. So because we are receiving money here, so these are all examples of cash inflows. When we talk about cash outflows, payment to suppliers, this is representing an outflow. So does the salaries and wages, rent, utilities and taxes, purchase of properties and equipments, and loan repayments and dividends. So we are repaying the loans and the dividends. Here it's dividend paid. And when we talk about capital raised from investors, this is actually a dividend received. No, sorry, not dividend received, but dividend income is actually a dividend received. When we're talking about capital raised from investors, this is equity which we have raised, equity investments which we have raised, loan taken from banks majorly. So all of these elements here are representing something which is um cash inflows, and all the line items listed here are representing cash outflows. So payments, salaries and wages, rent, utilities, taxes, purchase of property and equipment, loan repayments. We are repaying our loan which we have previously taken from financial institutions, or maybe from institutional investors. And dividend paid, we are paying dividend to our equity holders, which we uh, so we are basically paying dividends. I hope this much was clear, inflow and outflow, and these are the basic building blocks of what we are going to discuss in furthermore in the later readings. So net cash flow, let's talk about net cash flow concept. So net cash flow represents the total cash inflow and the difference between the total cash inflows and the total cash outflows. If total cash inflows is more, so it's going to be a positive number. But if the total cash flows numbers are out, cash outflows numbers are more, then this is going to be a negative number because of the cash outflow dominating the equation. And here the cash inflow, if the cash inflows is dominating the equation, so it's going to be a positive number. Cash outflow indicates that more cash is coming in than going out, and similarly, vice versa. Uh, Negative cash outflow represents that more cash is going out than coming in. And negative cash flows are not always bad, especially when business is investing for growth. But however, persistent negative cash flow is actually dangerous. So you need to have positive cash inflows. Yeah. And persistently having a negative cash flow is actually dangerous. Why is that? We will discuss about these things in later readings. Uh, okay, so now let's discuss about the three major types of cash flows. So three major types of cash flows are operating cash flows, investing cash flows, and financing cash flows. Operating cash flows is actually the cash generation for core business activities, and it includes cash received from customers, cash paid to suppliers and employees, and operating expenses. This is important because it shows that whether a business can sustain itself without borrowing or selling assets. And a healthy business should generate positive operating cash flows over time. What does the core business operations means? Let's understand this thing. Let's assume that you are a company which manufactures toothpaste, and over time you have generated and you have generated a lot of revenue. You have generated a lot of cash reserves. So let's assume that you are a cash rich company. You have a lot of cash on your balance sheet. Now you are going to invest this much cash in different companies. Let's assume either you are starting to invest this cash in different companies or different companies equity, let's say, or you are going to use this cash to uh, buy companies of buy let's say uh, you are buying a steel company. So whatsoever income you are generating from investing in different companies, buying steel, maybe buying a company which is a steel, and you are consolidating these revenues and you are representing it on your income statement. So this is not your core business activities actually. So these are not part of your core business activities. So being a toothpaste company, your core business activities, the revenue you are generating from toothpaste sales, that's only your core business activity. Unless until you are a company which is actually into investing or a fund management, or uh, let's understand this. I mean, this is just a hypothetical example, and so I hope you have understood this thing now. You are a toothpaste company, so your core business activity, your core business model is about toothpaste only. uh, Whatsoever other income you are generating, that's not a part of your core business activity. That's why if you can see here, cash received from customers, cash paid to suppliers and employers, and operating expenses, these are the only line items, or these are the few of the line items which are just an impression of, just so that you can get it, what I'm trying to say, convey here. These are the things which I am discussing about. These are part of purchasing or selling investment, which is a part of cash flow from investing activities. If you are buying a company, so or if you are paying, so these are part of actually cash flow for investing. You are investing your money here, so these are going to be part of your investing activities, not your operating activities. Operating activities specifically refers to, and I'm emphasizing on specifically refers to core business activities. Don't make a mistake of one. So when you will go through data, you will there is a possibility that you might get confused, but don't get confused. Uh, okay, I think this much is clear to you guys. So okay, let's talk about it, cash flow from investing activities. So cash flow from investing activities is actually related to cash from long-term assets and investments. And this actually includes buying or selling of equipments, property or machinery, or purchasing or selling of investments. Having a negative cash flow from investing represents that the company is actually investing in growth. So, investing in growth, and if you look here, equipments, property, and machinery. Equipments, property, and machinery are the assets which are later on help. These assets will actually help you to expand your business maybe. These will be beneficial for you in future when you are in expansion phase, and that's why negative investing activities represents that the business is actually into growth phase. When you are into growth phase, you invest a lot of money. You buy equipments, you buy properties, you buy machinery, and all of these doesn't have immediate effect on your cash flow statements. Initially, it's a negative. It's going to your investing activities are going to look negative, but these actually have a long-term positive impact. So, and a positive investing cash flow represents that the company might be selling asset, which is a negative, which actually is a downside when you look at the businesses. Um, Maybe the business is actually into saturation now. Maybe the market is actually into saturation. Maybe the business is not able to generate. I mean, the business is not able to find any opportunity to invest their money. So, a positive investing cash flow actually represents assets are being sold. Yes, it's a one thing, but it doesn't give a good sentiment to an investor. So, as an investor, you actually have to look. This is actually a red flag. When we talk about this, is actually a red flag. So, if you ever encounter a situation where the income statement, the cash flow statement has a in positive investing cash flow, then you actually have to look deep into this financial statements. And when we talk about the cash outflows, cash flow from financing, we actually have to, okay, so what actually is cash flow from financing? So, cash flow from financing is actually about the capital structure activities of the business, and it includes loan received or repaid. So, if we are talking about a capital structure of capital structure activities. So, we are going to use loans to fund ourselves, or we are going to repay the loans which we have used to help us expand. We are going to issue shares. We are going to issue shares, and shares are issued basically to raise equity. And dividends are paying dividends means that we are paying our investors, which uh, where I mean, we are paying our investors a certain amount every quarter, every year, uh, who have invested in our company through equity. And the interpretation here is that positive financing cash flow is actually it actually represents raising capital, and a negative cash flow represents that we are paying back the investors or the lenders as of. And it also can mean a lot of different other things also, but the simple interpretation here is that net positive cash flow is about raising capital, and negative cash flow is about paying back the investors or lenders. I hope the cash flow from operations, investing and financing is clear to you guys. Cash flow, let's talk about cash flow statement just briefly. So cash flow statement is actually a financial report that summarizes the operating, investing and financing cash flow, and it explains why the cash balance changes between two balance sheet dates. So the cash flow statement actually starts, just a brief explanation. The cash flow statement actually starts from net income. Then we add back the non-cash expenses. Then we adjust for changes in working capital. And this gives us our cash flow from operations. The changes in cash flow from investing and changes in cash flow from financing. When we add all these three, and this is going to be negative, this can be negative or positive, and this we prefer that it's positive. So this gives us changes in cash. So changes in cash for that period. So this is how, uh, if it's a positive number, if it's a negative number, we, so changes in cash. This is actually the changes in cash from the cash flow statement, and then we uh, link it to the cash on our balance sheet. The previous opening, we link it with that, and then we get the cash closing for that period. So this is how this is actually just a summarized version of cash flow statement. How does the cash flow statement works? And between two balance sheet dates means that uh, the opening, the opening and the closing. And the opening, the changes in cash we add in the opening, and the closing we get the closing. So opening is the previous date, and the closing is the current date which we're talking about. I hope this much is clear, and we will discuss about this in detail when we'll talk about the cash flow statements in our future readings. So, okay, there is this table which is important, and what does this table represents is that okay, so basis. When we talk about basis, okay, just give me a moment. My okay. When we talk about basis, so basis represents when that the income statement, the profit or loss statement means the income statement represent is the profit is calculated using accounting principles. Accrual concept comes into play. Accrual concept, matching principle, accrual accounting, matching principle, revenue recognition rule. So those comes into play when we talk about income statement. This means that profit is recorded when revenue is earned and expenses are matched. And even if the cash is not received, maybe it was a credit sale. But on the cash flow statement, when we talk about the cash flow statement, so there's a difference between income statement and the cash flow statement. So cash flow is purely based on the real money movement. So cash is only recorded on the cash flow statement when the cash comes in, and it's recorded when the cash comes in or cash goes out, and it ignores the accounting adjustments and focuses only on the physical cash transactions. And why this difference matters is because a business may show high profit but still face cash shortage if customers delay payments. So that's why income statement and cash flow statement and balance sheets are the primary financial statements which an investor looked at or an analyst looks at. And understanding these three financial statements is very important. When we talk about the non-cash items, so the income statement or the profits of the company or the organization includes the non-cash expenses such as depreciation, amortization, and the other provisions. And these expenses actually reduce the profit without any cash leaving the business. However, on the cash flow statement, this is not included. No. So cash flow actually excludes non-cash items because no actual money is actually paid. So that's why when we are talking about cash flow statement, so the non-cash expenses are actually added back in the cash flow from operations statement. And cash position does not change here. This is the main reason. The non-cash expenses, they actually never left the organization. So we are only talking about in the profit, we are adjusting these non-cash expenses, but the cash flow statement, that's why the cash flow statement actually adds back all the non-cash expenses. And this difference matters because a company may report low profit due to high depreciation, but still have strong cash flow. So if you're talking about depreciation, yes, we are subtracting depreciation in the income statement, but that depreciation amount never leaves the organization. So that's one important aspect. Okay. So when we talk about timing, so profits, when we talk about profits, profits are recorded when they are earned, and the profit means that goods are sold, services are provided, even if payment is received later, and profit is recorded immediately. But on the cash flow statement, we do not record it unless until the we have actually received the cash or we have actually paid the cash. So no cash means no cash flow in trade. So this means that when we will on the cash flow statement, basically we are only showing the flow, whether it's positive or negative, the flow of cash. If there is no cash flow, then we are not going to record those numbers. Okay, I hope this much is clear to you. And as of now, see, when we are discussing about the basic fundamentals of cash flow statement, so this much is, I think, enough to understand. And since we will advance in the lectures or in the later readings, we will discuss about these things in detail. But the fundamental understanding of the concept should be clear. Okay, so let's do an example here. There is an example. Let's say that you sell goods worth 10,000 on credit. So if you're selling something on credit, there was no cash inflow, but you will recognize the profit. Profit increases immediately. Cash inflow increase only when the customer pays, unless until your credit is actually converted into cash. So the customer has actually paid you the money. You will not record this entry on the cash flow statement. And this is why companies can be profitable but bankrupt. And bankrupt, this means that this is happening because the customers are actually delaying the payments. Okay, so I hope this much is clear. Let's talk about free cash flow. And okay, so free cash flow, this is actually an advanced concept after cash flow after the cash flows. Uh, Free cash flow is the cash left after paying for operations and capital expenditure. The cash left after paying for capital expenditure from free cash flow or operating cash flows. And remember this formula because this is going to be the foundation of free cash flow to the firm and free cash flow to equity. Free cash flow to the firm and free cash flow to the equity. So cash flow cash flow from operations, why does it matters and why it's used for? So cash flow from operations, when we subtracting cash flow, cash expenditure, this means We are trying to, so this is actually used when we are valuing a company, we are paying dividends, that when whether or not should we be paying our debt, or we should be raising debt, more debt, or should we expand our business, or should we contract. uh, Now understand this thing, cash flow from operations, this number cannot be negative. If the cash flow from operating cash flow is negative, this means that the business is not doing well. And capital expenditure, since uh, we have previously raised money, we are going to allocate a certain amount to our capital expenditure which we have previously raised. And afterwards, we should be left with something positive. Then only we will be able to value ourselves. The company can be valued. Let's take a hypothetical example. Let's assume that the cash flow from operations is 100 and we have allocated a certain amount of fund for capital expenditure. Let's assume $10, $10 million. Uh, so we are left with $90 million free cash flow. Now understand this thing. This $90 will be uh, the deciding factor whether okay, this is going to be a deciding factor. This $90 million is going to be a deciding factor when the investors will look at our financials and they will compare us across our peers. So this means they will be valuing the company, the valuing the organization. And this $90 will be the deciding factor. If we have enough surplus, whether then we will be paying our investors dividend, uh, then we will be paying back our debt, then we will be expanding. So this $90, the free cash flow is going to be the deciding factor. And the free cash flow number should be good. The free cash flow number says a lot about the organization, the way the management is running the business. So this is all assessed by free cash flow. So the importance of free cash flow decision making is that it assesses liquidity and solvency, how liquid we are, how solvent we are, how quickly we can generate cash, plan, budget, and forecast. Yes, I hope this much we have established here. Deciding dividend payments, whether or not should we, and how much should we pay our investors, and evaluating business valuation, measure financial health more accurately than profits. And just a simple real world example, let's understand a simple real world example here. Cash receipt from customers is 15,000, expenses are 11,000. So these are going to be a part of our operating activities. Equipment purchase is an investing activity. So if you look at this, so the cash operating cash outflow is 4,000 because 15,000 minus 11,000 is 4,000. And since we have purchased equipment, this is going to be a negative number. And the business is liquid. This in The interpretation is that the business is liquid, investing, and financially stable because we actually have a positive free cash flow. So net cash flow is positive. The key takeaways from all the above topics is that the cash flow tracks real money. Uh, Positive operating cash flow is essential, and investing and financing cash flows explain growth strategy. And cash flow is often more important than profit. So, I think this much is enough for today. We will discuss about the other topics in detail in the next lecture. Thank you for attending today's lecture. My name is Deepak Bisht, and I will see you in the next lecture.